want to walk you through some of the concepts in this chapter. I want to make you aware that I fully understand that some of these concepts are getting a little tougher, a little bit more confusing. Please don't spend a lot of time on something that you don't understand. Reach out to me. I can either help you through email. We can set up a time to meet. I can walk you through some of these concepts. I just don't want you to waste time if it's something that I can hopefully help explain a little bit more quickly. So we're going to start with this example here and walk you through how to calculate avoidable interest and when that interest should be capitalized and what amount. So this is an example from your book about this furniture company, and they're starting construction on an office and warehouse building. They estimate the cost to be $5 million, and they're going to finance that with a couple of different loans. They have a construction loan, a short-term loan, and a long-term loan. Now the first part of this is assuming that they complete the office building by the scheduled time. The total cost was $5.2 million, and the weighted average amount of accumulated expenditures was $3.6 million. So what is the amount of avoidable interest? As you can see, we took out $4.4 million in loans. So we want to see how much did we avoid in interest by only spending this 3.6. So to do that, we have to calculate first the amount of interest on this $2 million loan. We took all of that loan and paid it off by 2024. So that $2 million we're going to include. So that $240,000, we're going to include that in our avoidable interest. That's what we're calculating first. The second portion of this is the short-term loan and the long-term loan. Because we didn't spend all of that money, we're going to have to calculate a weighted average interest rate. That's going to combine these two loans to figure out how much interest rate we should charge for the additional $1.6 million. So again, we're trying to get to that $3.6 million for the accumulated expenditures. The question is, how much interest rate do we charge for that combination of the 1.4 at 10% and the million at 11%? So what we're going to calculate is that weighted average interest rate. Taking those two loans and combining them. So that 1.4 million, that was a 10%, and that's 140,000. And then the $1 million loan was 11%, which equals 110,000. What I'm going to do here is add these two numbers together. And then I'm going to divide that total interest by the total principal. So divide those two numbers. A lot of zeros. And I'm going to get 10.42%. So now I know the interest rate, or the weighted average interest rate that I would put for that $1.6 million. If I calculate that out, it's $166,720. giving me a total avoidable interest of $406,720. So that's your first part of this problem. What is the avoidable interest on this project? Saying if I didn't do it, how much could I save? The second part of this project, or this question, is asking you to compute the depreciation expense. Straight line basis, 30 years is the useful life. Salvage value is $300,000. So we don't confuse these two. Change colors there. And what we need to do first is to compare our actual interest. Compare that to our avoidable interest. Now we know our avoidable interest was $406,720. The actual interest that we would have paid is going to be the 140 plus the 110 plus the 240. So if I add those three numbers up, my actual interest again is the 240. It's going to be the 240 plus the 140 plus the 110. And that's going to equal 490. Now, since the avoidable interest is smaller or lower than the actual interest, we're going to use this avoidable interest to capitalize for the cost of the project. So I'm going to calculate my total cost by taking that $5.2 million that they started with, that was given in the problem. I'm going to add the $406,720. This is the interest I'm going to capitalize. So I'm going to add those two numbers together. 5,606,720. And now I can do my depreciation calculation. And to do that depreciation calculation, you're just taking, to calculate that depreciation expense, you're going to take your cost, which I just figured out, minus that salvage value, which they gave me, and divide that all under straight line by your useful life. So my depreciation expense should be $176,891. There's one answer there, second answer there. So hopefully that makes sense. Just putting it in two different steps I think is helpful, and trying not to combine all those numbers. It gets a little bit difficult. All right, let's look at this other concept, and it's recording an exchange with a commercial substance. So what we want to look at here are the journal entries that go along with recording this. And so this Busy Town Corporation is buying they're giving you a lot of story. They gave the machine plus $340 to this other Dick Tracy company in exchange for a new machine. Then they're giving you the details on this. Did I need to know that they just hired an accountant? No. We don't need to know that he's a recent college graduate. Sometimes they put all this stuff in there to make it more interesting, and sometimes they put it in there to try to confuse you. So what we need out of that whole paragraph is that the machine, BusyTown gave the machine plus $340 to Dick Tracy in exchange for this new machine. So let's look at what this looks like from both perspectives. So let's look at the BusyTown first. From their perspective. So they gave their old machine plus $340 to Dick Tracy, right? The old machine's cost was $290. And what else do we want to pull out of here? Whenever we get rid of a machine, we got to get rid of the cost and the accumulated depreciation. We want both of those things off our books. So I always try to put those in first so I don't forget them. So we're going to debit that accumulated depreciation. Remember, that usually has a credit balance. We want to get rid of that with a debit. That machine cost we need to credit. This is the old machine, just to be clear. So we're getting rid of that. That was $290. We also gave them cash. We're giving them cash. That's a credit to cash, and that was $340. We are then having to record that we got a new machine in exchange. And that new machine's fair value is $425. That's what we want to put it on our books as. We also can note that the fair value is equal to the cash that we paid plus the fair value of our old machine. Now, remember, debits have to equal credits. Going back to accounting 101, right? We're missing something here. What we're missing is the loss. So we have a loss on disposal. Our debits have to equal our credits. So I know that's $65. Or I can compute that loss by taking my book value of my old machine, and I know the cost was $290 minus my accumulated depreciation, so my book value was $150. I'm going to subtract my fair value, which was $85, and that will tell me that my loss was $65. Again, once you put all of the other knowns in there, you should be able to calculate just based on the fact that your debits have to equal your credits, but you can also verify that that loss is calculated correctly. All right, now let's look and see what this looks like from Dick Tracy's perspective. Right? They're getting the cash. So this cash that's getting paid here, coming right down here. We're adding to our inventory the fair value of the machine. Remember, the BusyTown gave their old machine plus $340 in exchange for a new machine. So we got that old machine, and then we can record our sales revenue of $425. Now your book might combine this all into one. That's fine, but I kind of want to show you where this is coming from, because this is recording the sale. But we also have to record the cost of goods sold. And to do that, we're going to debit our cost of goods sold. And that's going to be for the machine cost here. Notice it has no accumulated depreciation. So that would be 270. And we're going to decrease our inventory also by 270. So now you can kind of see how both companies are looking at the sale of that machine. All right. Now let's look at how do these wordy problems turn into a simple multiple choice question on a test. So that first one, when we're talking about weighted average accumulated expenditures, 1.6, they want to know how much interest should be capitalized on this loan based on that amount. And so what we have to calculate is the difference between, remember, avoidable interest and actual interest. And we're going to take whichever number is smaller. So our actual interest is the 200,000 or 2 million times 10%, which is 200,000. Our avoidable interest is going to be based on the weighted average accumulated expenditures, which is 1.6 million. Now in our example problem, we had to do a lot of calculations to find that weighted average interest rate. Here we don't have to do that because there's only one loan. So we're going to times that by 10%. We get 160,000, and we pick the lower number because you're actually going to capitalize the lower amount. So our answer would be C. And let's look at these journal entries in a multiple choice format because these can get a little tricky. Just because when you're seeing all the different choices, sometimes it's hard to just pick which one. I always recommend writing down before you look at the options and then matching which one's correct. But you can, if you're not comfortable with that or just kind of don't know where to start, you can always start with something that you know. So here they have an automated machine press, and they gave $40,000 in cash. So right there I can stop, and I know if I gave $40,000 in cash, I should see a credit to cash for $40,000. A has that option, B has that option. C does not have that option, so I'm going to cross that out immediately, so I don't even look at it, and D has that option. Then I'm going to go through and read and see what else I can find. It said the old machine cost $465,000, and it had a net book value of $355,000. So that means my accumulated depreciation is $110,000. So remember, anytime you dispose of an asset, you're going to get rid of the accumulated depreciation with a debit, and you're going to credit the machine, or here we're calling it equipment, for the cost. The cost was $465,000. So now I'm looking for those two pieces of the journal entry. I got the cash portion in. I'm looking for these two pieces. Let's see. I'm looking for a debit. We have, let me go back here. We found the cash, right? Now we're looking for these two pieces of the puzzle. We need to find the debit to accumulated depreciation, a credit to equipment. That one has it, so that's a possibility. B is not an option anymore. I can cross that out. D has that credit to equipment, but it has also a credit to accumulated depreciation. Now maybe I got this wrong and I'm not quite 100% sure. So I'm leaning towards A, but I want to just double check and make sure. So the question is, do I have to record this old machine had a fair value of $300,000? Do we care about that? What else do we know? That they gave $40,000 in cash. So remember, just like we did in that problem above, the fair value of the new machine is going to be the fair value plus the cash received. So that new machine should be recorded at $340,000. This is. Whereas this is recorded at $615,000. So I'm pretty confident that this is the wrong answer. I can cross that one out. I'm a lot more confident that I got this one right. I mean, I can go ahead and calculate that loss just to make sure that that's the right amount. And you know, the book value is $355. The fair value is $300, giving me a loss of $55. So now I've calculated that. I'm 100% confident that A would be the correct answer. So hopefully those two problems and the two multiple choice help out a little bit with this homework. But again, please let me know if you've got questions or if there's anything else I can help with.